Welcome to Corporate Banking Snippets. Snippets are short descriptions of key concepts in corporate banking. This is one of 100 different snippets in the process of being uploaded to YouTube. This one is a financial accounting snippet and illustrates how the income statement works. In order to analyze and interpret financial statements, we need to understand how they are structured in the first place and what the different components mean. Some of the terms used here and the format may differ from case to case, but the principles are the same. Let's start by listing the key components of the income statement. A problem you will see shortly is the cluttered nature of this information, but we will declutter the screen later on. We start with the company's sales figures, also known as turnover. This is the amount of goods and/or services in money terms that the company has sold during a fixed period, normally a year. We then deduct the cost of goods sold. Cost of goods sold is also known as variable or direct costs. The gross profit then tells us whether or not this company is making money between the cost at which it buys items and the price for which it sells them. It takes no account of the money spent on the day-to-day running of the business. Gross profit is hugely important because if a company is making losses at this point, it is impossible for it to survive from its core business. To be successful, gross profit has to be big enough to cover the operating expenses of the business, and then interest, depreciation, taxes, dividends, and then leave enough money for retained profit to be reinvested in the business. Moving on, the company has to meet its fixed costs, also known as factory costs or indirect costs, such as salaries, rent, utilities, and all expenditure that does not correlate directly to sales. Deducting fixed costs from gross profit gives net operating profit. Interest and depreciation are deducted from net operating profit to give profit before tax. Deducting tax gives net income. Deducting dividends or drawings gives retained earnings. If you check out the snippet on the balance sheet, you will see how retained earnings are added to shareholders' equity at the end of each financial year. So, time to declutter. You can see we've removed duplication of terms and indented subtotals to be more reader-friendly. Let's add some numbers to see what the income statement can tell us. So, this company is profitable at all levels. Check out how the gross profit figure covers all of the outgoings lower down in the income statement and allows $5 million to be reinvested in retained earnings. Just a quick word about conventions. It can be a bit frustrating sometimes to work out which numbers are being added and subtracted in an income statement. We could be more explicit with brackets for deductions, but then the income statement would look more cluttered. So once you've got the hang of what is being deducted from what, and the conventions shown of no brackets and single lines hovering above subtotals, it is probably more reader-friendly. What can we see at a glance? Sales and cost of goods sold tell us this company sells units of production for almost double what it pays for them, so it must be adding a lot of value. Low figures for interest, depreciation and tax could be a sign of good management. Dividends at 1/3 of net income allows healthy reinvestment of profits while keeping shareholders happy. Check out our snippets on ratio analysis to see how we analyze the income statement in more detail.